Brian Stevens with the Mortgage Shots. Cool, I got my chats here. Hey, listen, by the way, if you're watching, sharing is always caring. I say this for a variety of reasons. One of them is what is it called? Meta? The new site Meta, also known as Facebook. They like it when you pay a lot of money to them in order to get your message out. And so I just kind of think it's cool when we can share stuff naturally, virally, the way that it's always been done without manipulation or input from third and fourth parties. With that saying, they're probably transcribing absolutely everything I'm saying right now and going to get me blocked. But if you hit share, that's helpful to me, and hopefully it's helpful to you too. I'm going to ask a real quick question. Joanna, can you shut that door and open up, guys, and let me know if we need something here as we're going forward. But we have some really great opportunities today of things I want to talk about that could really change your business. And I know we have this conversation every day, but the question is, are you really doing the things that we're talking about? I certainly hope so. By the way, so today we are going to be doing things a little bit differently. We are going from multiple Facebook pages. We're going from multiple YouTube pages. And we are going to be doing some editing once again with our Facebook Lives and our YouTube Lives. So one of the things I want to let you know is my good friends over at Oak Tree Funding want to wish you a Merry Christmas. We'd like to wish them a Merry Christmas for being such great partners in the non-QM space. Guys, right now you have to understand that Oak Tree Funding right now has some of the best bank statement loans out there, the best priced. They will price match anybody in the non-QM space. And as we spoke about yesterday, understand this, that non-QM right now, we spoke about, there's 30 million people who are occupying the gig space in terms of what their job is. The gig space is one, like a giga, they're doing technical work, but the second part of the gig space is they are doing gigs. Once they're done with a job, they move on to the next one. These are people who qualify based on bank statement type of alternate documentation loans. And there's 30 million in the country. These are high-paying jobs, and these are ready, willing, and able-bodied buyers, and these are people that we need to be talking about and talking to. These are, the demographic is perfect. There's people in their late 20s to mid-30s who are working gig jobs in the tech sector, and they need your help. They need to go alt doc, and Oak Tree Funding is here to help you out with the gig sector. We also know that nearly 100 million people, or excuse me, there's another 60 million people right now who are getting back into full-time work, going from being or underemployed as a result of COVID right now. So when we look at the 60 and the 30, the 90 to 100,000 people, it's about 25% of our population right now who would benefit only and exclusively from bank statement or alternate documentation loans. So as a loan officer and a real estate agent, if you would like to find 0.25% of the population, these self-employed folks who do want to buy houses, you could start at a really great spot, which is going to be over at Oak Tree Funding. And by the way, I say this quite a bit, but if you'd like to learn more about how we're doing this, you can certainly go ahead and reach out to me. Or if you have any ideas on shows that you'd like us to go over, you can certainly reach out to me. Just hit instant message over to, it's called Mortgage Shots or the National Real Estate Post, the site you're watching right now. And I'd be more than happy to go ahead and do that. So let's jump into a couple of things that I think are pretty interesting. And then we're going to go into what's called camera in camera. Okay. So here's the first thing that I want to go into. And again, I'm trying to actually produce the show as I'm producing the show as I'm shooting it. Okay. So you guys probably saw today that FHA announced their new loan limits for home equity conversion mortgages and single family homes. Now, this is really interesting here because everybody's just going to say, and very rightfully so, that we're just talking about new FHA loan limits. Now, when I first started doing this 15 years ago, which is 15 years after I started writing loans, I remember when our FHA loans, they started out and they were in the $90,000 back in probably, I don't know, 1997, 1998. Yes, I'm dating myself. But if we look at what the charter is for FHA loans, the charter is to serve underserved communities. That's exactly who they are. And the idea of the FHA loan is to take the person who is not marginally creditworthy, but somebody who's maybe had a less than exemplary past with their history of credit, but are doing a better job, don't necessarily have a big down payment, but are hardworking folks who want to own a house and deserve to own a house. And I've been saying this as recently as a couple of weeks ago. I said, my God, well, FHA, they want right now to help underserved communities. They want to go out there and they want to help the first-time home buyers. They want to help those who are on the outside of home ownership looking in. And yet their loan limits were lower than what the national average sales price for a house is right now. So that's great that we have all these lofty ambitions and desires to go out there and help people. But when your loan limits are lower than the average house nationally in the United States, that means that we are going to have more people on the outside looking in than the inside looking out. Because remember, your average loan size nationally is not only going to be based on California, New York, Colorado, Seattle, and the big cities that everybody's going to recognize, but it's also going to be parts of North Dakota, Mississippi, Alabama, Arkansas, Missouri, who have significantly lower home prices. So we're looking at this right now and saying, okay, this is a great move by FHA, and which, by the way, they have a congressional mandate to actually do this. FHA didn't just raise their loan limits because they had to, because they wanted to. They did it because they had to. They had to because they have a congressional mandate, but on top of that, they had to do it because they were getting close to being absolutely irrelevant as a source of funding for mortgages in the United States. So when we see that FHA raise their loan limits, we all go bravo. I mean, not a lot of people right now, especially first-time home buyers, when we're looking at the median sales price for a new house being somewhere to the tune of $400,000, have $80,000 to put down. So yeah, the FHA, 3.5% that you're going to put down is going to be a heck of a lot more attractive, even in spite of the fact that they have their higher mortgage insurance. But did they do a good thing, or did they do a thing that was not necessarily in everybody's best interest? Let's kind of consider this for a moment. I want you to look at this. See, as I told you before, FHA is required by the National Housing Act, the NHA, as amended by the Housing and Economic Recovery Act of 2008, HERA, we all know the name HERA, don't we, to set single-family forward mortgage loan limits at 115% of area median house prices, subject to a floor and a ceiling of the limits. In accordance with NHA, FHA calculates forward mortgage limits by metropolitan statistical areas. All right, this is fairly straightforward. It's a lot of legalese, but it is fairly straightforward. One, FHA has to do it. Two, they have two mandates, the NHA and they have HERA. Three, they must set their loan limits based on a strict figure, which is 115% of the median area, subject to floors and ceilings. Meaning we're going to go 115%, but we don't know exactly what that is. So we're going to make sure that we don't go below a certain number, and we're going to make sure that we don't go above a certain number. It's all fairly straightforward, and this is going to be based on different metropolitan areas. Okay, so that means we're going to have higher FHA loan limits in San Jose, California, where the median sales price for a house is north of $3 million, versus Bismarck, North Dakota, where the median sales price for a house is $225,000. That makes sense to me. But is this exactly what FHA did? So let's continue looking at this. Again, I'm trying to work through this. Okay, can you guys see this? What I'm actually going to do now is I'm going to increase the size so you can read this along with me. And I know you can't see me, so we'll do this. Now you can see me, right? Okay. Here's what I need you guys to understand. For most of the United States, the loan limits for FHA mortgages are going to increase to $420,680. That's a number that falls in line with what FHA has traditionally and historically done. That number kind of makes sense, okay? Okay, so we're going up about $80,000-$90,000. We got 2% appreciation across the board per year. That number sounds a heck of a lot like the 115%, which their HERA mandate demands that they do. Now, they say that this is for most counties. Specifically in areas where 115% of the median home price is less than the limit. This equates to 65% of the newly announced conforming loan limits of $647,200 for conventional loans. And as we know, HUD, the FHA, Fannie, Freddie, and the FHFA are all communicating on a multitude of levels that they have not done in years past, primarily on enforcement issues against mortgage lenders. That would be you guys, okay, primarily in that area. But it stands to reason, just a couple of weeks ago, we got Fannie and Freddie's new loan limits, which was close to $1 million across the board in high limit areas, and $647,000. And remember, Fannie and Freddie have a different charter. They have a different mandate, a different mission statement than FHA and the HUD have. Fannie and Freddie are going after somebody who primarily has a larger down payment, somebody who probably has better credit. To this day, Fannie and Freddie are still writing on average loans that have credit scores above 740, which is absolutely ridiculously high. But they do have a different charter, don't they? So when we say that, well, we're going to be at 65% of what the maximum for Fannie and Freddie are, which is 647.2, makes a lot of sense, doesn't it? Because we're going after that first-time home buyer. By the way, guys, stick with me if you can, because this becomes very, very fascinating. Now, look at this. Areas in which 115% of the median home price is above the new FHA mortgage limits are considered high-cost areas and have new loan limit ceilings of $970,800, or 150% of the national conforming loan limits, 150% of the 647.2. So they went 65% for their national rollout, but they went 150% of their national rollout of Fannie and Freddie's if you are above 115% of the median area. Well, how many areas in the United States, as far as housing goes and equity goes, are above 115% of the median? Well, the answer is a lot. So, when we have $1 million FHA deals, has the FHA blown beyond what their mission statement is to serve the underserved community? How many underserved folks do you know right now buying $1 million homes? Is that really fulfilling the mandate of FHA? This is where Fannie needs to be. This is where Freddie needs to be. But is this necessarily where FHA needs to be? And I ask it for this reason, because FHA is going to be more lenient with their underwriting guidelines. FHA has a higher default rate. They have always had one historically. They're supposed to have one historically because they're supposed to be taking on more challenged, low-income, higher-risk, higher LTV borrowers because they're serving underserved communities. So the question I have for you is, how many people do you know who are underserved, who are low to moderate income folks who are buying houses that are selling for $970,800? This is a very important point here, guys, because they're only going to be putting 3.5% down. They can have multiple credit blemishes, so it's high LTV, it's high credit risk, and we can even have deviations in how we determine that income, and we can have deviations or we can have employment gaps that further complicate what would otherwise be a clean file. In short, a $1 million house that Fannie and Freddie are going to turn away every time because it's deemed too risky might walk through the front door of the new FHA. And I'm just questioning, is this their charter? Is this where they need to be? Well, there's arguments for and against this, and I want to go through both of these. And again, you're just going to have to bear with me, guys. I'm still trying to go through this. Well, here's what I want you to think about right now. And I'm actually going to change this up. I'm going to go camera and camera here. Just hang tight with me. This is going to look a little funky for a second, but bear with me as I try to pull some stats up that I think are going to be beneficial to you. They might not look exactly how you want them to, but I'm still working through this new software as well. Okay, so check this out. Okay. Bear with me. Okay. Here's the argument for and against this in both the same breath, if you're looking and reading this right now. Okay? Now, I don't know if you guys are aware of this. We've talked about it ad nauseum in the past. But FHA has a requirement to have a threshold of slightly above 2% of everything that they're insuring in a kitty in the event that they're going to have a foreclosures. So if I'm insuring $100, I need to keep $2.25 in the bank on my side. That's what I need to do. If I'm insuring $1,000, I need to keep $200. If I'm insuring $20,000, I need to keep $2,000. Does this make sense? That type of thing. And it's called the capital reserve requirement. So this is going to tell you the health of Fannie and Freddie. If their congressional mandate on their monthly mortgage insurance capital requirement percentage, if it falls below 2%, Fannie and Freddie could be looking at a bailout, which is what happened in 2008. So they want to make sure that they're not lending to too many risky people, because risky people have a tendency to get defaulted on, and when they get foreclosed on, that money to cure whoever the investor on that note was is going to come. It's going to come out of FHA's MMI account. So overall, the capital ratio requirement for the year ending 2021 was 8.03%. Now, I just told you Fannie and Freddie are required to keep 2%, and they're sitting at 8%. I just had a conversation with Dave Stevens about this a couple of days ago, and he said, well, it's time for FHA to lower their monthly mortgage insurance because they've got nearly 4 times the amount of money they need to have on hand to mitigate any risk of foreclosures for their book of business going forward. And that seems like a fairly reasonable place to be. So they're 8.03%, and that's an increase of 1.93% from the year 2020, which was at 6.10% of a capital ratio. Their capital ratio is an indicator of the MMI fund's financial health and includes both the FHA's insured single-family forward and reverse mortgage portfolios. So you see what I'm saying here, guys? FHA is sitting on an absolute ton of money right now. And that's a good thing. How much money are they actually sitting on? How much money does Fannie and Freddie have right now? Well, here's what they have right now. They have, Fannie and Freddie, as of September 30th, 2021, and this is HUD's testimony to Congress over the health of HUD and the FHA. FHA has active insurance on more than 7.8 million single family forward and reverse mortgages, with a total unpaid principal balance of more than 1.2 trillion. That's trillion with a T dollars. So they're sitting right now on 8%, 8.03% of $1.2 trillion. What is 8.03% of 1.2 trillion? And as you can see, I've already done this. It comes out to 900. What is that? Let's see. How many zeros here? 1, 2, 3. 1, 2, 3. That's million. That's 96 billion. $360 million that FHA has right now in folding money. FHA has $96 billion $360 million in their rainy day fund in the event that they're going to be facing any type of foreclosure epidemic. This number, as I told you, is nearly 4 times higher than what their congressional mandate is. So right now, you guys are thinking, well, hell, why shouldn't Fannie and Freddie, why shouldn't FHA? Why shouldn't FHA then just go out there and raise their loan limits to whatever they want and start writing more loans? Because clearly the book of business that they've been writing over the past 10 years has gotten too conservative, because there are no foreclosures, and all this mortgage insurance that they're gathering on a monthly basis and on an origination basis far exceeds what they need to have on hand in order to be financially solvent going forward. And that, my friends, would be absolutely accurate. Okay? So one thing is lower the mortgage insurance fund. But here's the other little sneaky thing that nobody's talking about, and then I'm going to tell you guys what's in this for you. Here's a sneaky thing that nobody is talking about. Okay? What they're not talking about is that we have a very recent history of FHA's insolvency. Significant recent history of FHA's insolvency. So I'm going to go back to my camera, and I promise you guys I will make this so much better here in the near future. But I want to show you a couple of things, if I can. Okay. This right here is from the report that I just told you about from FHA to Congress, their agency financial report. Okay. Now, this is from HUD for the year 2012 that we're looking at. This right here is only 2012. This isn't today, but this is going to give you an indication as to what I'm talking about and what my concerns are today. The MMI capital ratio of FHA in 2012 was negative 0.44%, meaning they fell 1.44% below where the threshold. Actually, they fell further than that because that was if they're at zero. They needed to have a congressional mandate at about 2%. So they fell nearly, roughly 4% below what their congressional mandate was. And FHA didn't even have enough money in their accounts to deal with the foreclosures that they were facing. Well, Brian, that's the problem that we face. They shouldn't have been writing those risky loans. Well, were they writing those risky loans? Look at this, guys. Look at this. Let's use our mind. In 2006, prior to the meltdown, their MMI capital ratio is 6.82%. 6.82% ain't too far off the 8.03 that we have right now. So FHA, when they decided on the lead up to the meltdown, yeah, let's open this thing up. Let's start writing riskier loans. Shit, we can do this. We've got almost 7% in our MMI rainy day foreclosure account. We are so far beyond what Congress requires of us, we can go ahead and lend more money to more people and make more homeowners of American citizens all across this country. This is a great time just to clear the pipes, pedal to the metal and floor it, and let's do it because we've got so much money. This is the mindset we're sitting on right now. But this was also the mindset that we were sitting on in 2006. Because remember, we were flying high in 2006. We had the same type of irrational exuberance about the housing market where nothing could possibly go wrong. Buying real estate for the sake of buying real estate was going to make you money, and there was no way to lose. Didn't matter what loan you got, didn't matter what rate you got, didn't matter what fees you paid, you could not lose, and that was the mindset in 2006 when the FHA was flying high. But then in 2007, we started to find, some chinks in the armor, didn't we? We found some cracks in the dam, didn't we? Because in 2007, we went down to 6.4%. Then in 2008, as Kiss once so horribly sang, off the record Unmasked, in probably 1989, all hell broke loose, didn't it? In 2008, the house of cards that all of the United States real estate was built on fell apart, and that MMI fund went down from 6.4% to 3%. Now remember, guys, when we're talking close to $1 trillion here and we're dropping 3% of $1 trillion, how many billions is that? How many hundreds and hundreds of millions and billions of dollars is that? Well, it was absolutely catastrophic. But boy, wasn't that just the beginning. Because just 3 years removed from 2006, by the time we got to 2009, that MMI account had fallen below what the congressional mandate was. Now FHA was running at a deficit. They were a failed company at this point. In 2009, they were down to 0.53%. 2010, they were at 0.5%. 2011, they were at 0.24%. And in 2012, they were absolutely 100% busted upside down. So in a 6-year period, we went from nearly 3 times the congressional mandate of our MMI capital ratio, and we blew that thing out of the water and basically bankrupted a company. So when I'm telling you today we're sitting here over at 8%, when I'm saying we're sitting at 8%, there's no way we can go wrong on this. There's no way whatsoever we can go wrong on this. I'm saying, well, hold on a second here. I can tell you in my professional lifetime, I've seen this whole thing happen once before, and I saw the whole thing go ass over tea kettle. And yes, it was at this time that Fannie and Freddie were essentially bought out by the United States Treasury for having the same type of failures on their end. So why do I bring this up now? I bring it up for a couple of reasons. It's very simple here. You could be saying to yourself, well, yeah, Brian, but back in 2008 and 2009 or 2006 and 2007, FHA was, God, they weren't insuring as much as they're insuring now. And you would be absolutely correct. You'd be 100% correct. But here's something that you need to look at. Let me see if I have it here. Nope, I don't. I'm going to close all these out. Well, here's what I'm going to tell you, because I know it off the top of my head right now, is the FHA had a max loan amount that was in the 200,000s, and they had a max loan amount that was in the 300,000s for their high cost areas. Today, those numbers are high 400s and nearly $1 million. So yes, back in 2006, FHA was not did not have the same type of MMI fund as we have now, but their defaults were significantly less than they're going to be now. You default on somebody who has a $200,000 house, and you have default on somebody who's got $1 million house. What insurance premium is going to have to pay out more to that mortgage-backed security holder to make them whole? On the $200,000 house or the $1 million house? Well, all day long, it's the $1 million house, isn't it? And here's the other thing to consider. When things go sideways in real estate, what's the first market to fall? Is it the entry-level homes? Hell no. People still want those houses. Shit, we can't get them today. Are they your move-up homes? Not them either. Are they generally your low-cost, blue-collar, meat and potatoes cities and counties and communities and states? The answer is emphatically not. Remember back in 2008 who died? It was the sand states. Remember that? Sand, S-A-N-D. States with sand. California, a sand state. Nevada with Las Vegas, a huge second home community, sand state. Phoenix, Arizona, a sand state. All of Florida, a sand state. And these were cities, communities, and states that saw massive, incredible short-term appreciation on their real estate, and then they all of a sudden sunk overnight in the sand states. So the ones who falter the first when things start to go sideways are going to be your high-end real estate. It's not your low-end, it's not your move-up house, it's your high-end real estate. So by FHA moving to saying, hey, yeah, I think it's a good idea for us right now to start lending $1 million to somebody who's only got 3% to put down, with somebody who's got a 645 credit score, and somebody who's worked at 6 jobs in the past 2 years. Yeah, that's who I want to have on nearly 100% financing. And yet that's precisely what they're doing. And I'm saying before you choose to do that, you might want to go look back at 2006 and see how that irrational exuberance worked out for you then. It didn't just tank the United States housing market, it tanked the global economy. But again, this is me being a little bit henny and penny. I'm not saying this is going to happen. But I am here to tell you that we have, for the first time since the meltdown, the Dodd-Frank meltdown of 2008, we have cleared a path for a major catastrophic problem, and it could start with the FHA and HUD. Frankly, their loan limits are too high. If you're living in San Francisco, if you're living in New York, and the median sales price for a house is $3 million, I got news for you. You need to commute. You need to commute. You don't need to be buying your first house for $1 million. You need to commute. I can drive to San Jose from my house right now in 1 hour. And you could buy a house for half that where I live right now. Actually, you could buy a house for a sixth of that because in San Jose, California, your median sales price per house, I believe, is right around $3 million. And out here in Vacaville, beautiful Vacaville, California, it's only $500,000. Okay, so you guys wanted to find out like where the opportunity lies here. Let me explain to you where the opportunity lies. And again, I want to let you guys know one last time that this is being brought to you from my great friends over at Oaktree Funding. Non-QM deals, those gig borrowers, great interest rates, alt-doc loans with the ability to repay being built into these things. You want to make sure that your self-employed people and your gig borrowers are getting the best rates. They have a price match guarantee on absolutely everything they're doing. Check these guys out. They're absolutely killer to work with. Call them up and they'll either meet or they'll beat any rate on your non-QM. Okay. Boy, that was really good. That one actually worked out well. Awesome. Okay, so here's where the opportunity is, and I thought this was pretty interesting. So your HECM loans, reverse mortgages, have the same max loan limits as your high-valued FHA areas. So it's $970,000 for every HECM loan in the country. The difference is we're going 115% of the median sales price for metropolitan areas to determine what the high balance areas for your FHA forward purchases are going to be. But on your reverse mortgages, every single reverse mortgage now goes to $970,000. Why is this significant? Well, let's see. Who's sitting on equity? And we talked about this yesterday. We're just going to put that thing on steroids today. Who's sitting on equity? It's people who've owned their house for 40, 50 years. It's people who have not refinanced their houses, not cashed out their houses to go buy Wave Runners and toy haulers and Kawasaki's and Sea-Doos and entertainment centers and all that shit. It's senior citizens. It's the greatest generation. We're seeing the last of the greatest generation ever, aren't we, right now? We just saw this Pearl Harbor remembrance, which was crazy interesting to watch. But yeah, that's 80 years ago. So who's sitting on this money right now? Well, it's going to be senior citizens. It's going to be senior citizens who have not refinanced their houses, who've owned them sometimes generationally, have certainly owned them decades, and they've been on the receiving end of all of this equity over the past 10 to 20 years. Oftentimes, these senior citizens are sitting in communities, in houses, in areas that are matured areas, mature trees, matured parks, and oftentimes these are the most highly desirable areas in any community. That's how it is here in Solano County. I would venture to guess it's exactly how it is where you live. When we look at all the high-cost areas in the Bay Area, and I'm only looking at my surroundings areas that I know, it's all the older communities that have been around for quite some time. All the areas out in Marin, that's where it is. The areas out in Walnut Creek. If you're going to go out to like Carmel, if you're going to go out to Mendocino, they're not building new houses out there. That's not where the money is. The money is in the houses that have been sourced and seasoned and been there a long time. And those houses are occupied by senior citizens. And now every community, it doesn't matter if you're in, Missoula, Montana. It doesn't matter if you're in Festus, Missouri. It doesn't matter if you're in Tucumcari, Texas. Doesn't matter where you're at. Doesn't matter if you're in Vacaville, California. Doesn't matter where you're at. $970,000 is what your loan limits are going to be for a reverse mortgage. What we know about senior citizens right now is they are cash poor oftentimes, okay, and they're equity rich. But the thing is when you're looking at, like, let's say that you have a house that's worth, you have a newly minted senior citizen, somebody who's 65 years old, okay, and they bought their house, 15 years ago. They've refinanced it once or twice, pulled a little cash out. Do we have enough equity and age positioning? Do we have enough equity and age in order to get them in to make a reverse mortgage actually beneficial for them, to where they're getting paid back enough money to where this kind of makes sense? And sometimes if you're too young and your house does not have enough equity and rates are getting too high, these three factors are going to be of major significance in terms of how much money you're going to get if you go into a reverse mortgage. All reverse mortgages are non-recourse loans. Meaning, even if you borrow more than what the house is worth, there's no recourse for that investor. It's going to get paid from the MMI fund that I told you just has $100 billion in it. That is factored into what I'm talking about. And the biggest underperforming part of the congressionally mandated MMI fund for FHA is reverse mortgages. And here's the reason why this sounds really bad. People are living too long. They get a reverse mortgage, they get money back out every single month, and then they pull more money out than what their house is worth, and they eventually get upside down, and there's no recourse for that. That has probably changed in the past couple of years, because we know right now with 1 to 2% appreciation on a monthly basis, 12 to 24% annual appreciation on our properties. I mean, these numbers are pretty crazy. And with interest rates as low as they are right now, it's pretty crazy. So when we look at somebody, a senior citizen who might be sitting on, who knows, $200,000, $300,000, $400,000, $500,000, $600,000, $700,000, $800,000, $900,000 in equity, massive amounts of equity, massive amounts. That means what their monthly draw will be on that house could be remarkably significant if they chose to. And the thing with a reverse mortgage is that you guys know you don't have to take the money. You can pay your mortgage. You don't need to take it all. You could return your money. You could pay all your money and then say you want all your money back. All of these options are available for you on these federally insured loans called HECMs or reverse mortgages. But now when we're looking at rates as low as they are, seniors with the enormous amount of equity, more than we have ever had in the history of this country, and that's an absolute fact, rates lower than they've ever been, equity higher than it's ever been. And now with our new loan limits on reverse mortgages, which are standardized for every city, county, parish, state in the United States, not just the continental United States, all of them. I don't know if you could do them in Guam. I think you can in Puerto Rico. I'm not sure about Guam. You probably could. But the point is there's an enormous untapped market for this loan right now, especially right now with these new loan limits. So you as a loan officer, you as a real estate agent, you need to go out there and start looking at reverse mortgages for 2022. There's going to be great opportunity here. Now, I hope you understand this. Well, a couple of things. First of all, reverse mortgages, they pay more, they pay well, they're great loans, they're easy to write. They're super easy. There's virtually no qualifying in these loans. Virtually. But here's what you're going to run up against. They're not easy loans to do. They're not easy loans to do because there's an inherent distrust about reverse mortgages in this country. Now, one of my friends said before, and I thought it was one of the greatest things ever, he said, if we ever just called these retirement loans, there'd be a line around the corner to get these things. Yeah, when you retire, go get yourself a retirement loan. It looks, acts, behaves, and quacks just like a reverse mortgage. If we did that, people would be making so much more use of these type of loans. They'd be great, but that's just not where we're at right now. So what you're going to have to do is maybe dispel some of the myths, and you're going to have to understand how these works, and you're going to have to build trust with seniors in order to make this happen. But what you can do is very simply, very easily, and it's just a couple of clicks away, you can find out everything that you need to know on reverse mortgages, and then you can also get lists and opportunities with businesses to start taking advantage of these loans. Because again, with $970,000 loan limits on a HECM, you could have an absolutely transformative experience on a cash poor senior citizen's life that would be wonderful for them. Wonderful. I'm so hesitant to even say this, but I'm going to. One of the main reasons why reverse mortgages don't work is because their kids, blood-sucking kids, want the equity in mom and dad's house after they die. And so the concern is when you do a reverse mortgage, they're going to lose the house. They're not going to lose the house. They're not going to lose anything. They're not going to lose a damn thing. What we're going to do is allow mom and dad to go ahead and tap into that equity so they can have that quality of life, for the remaining years of their time on earth here. But when you're looking at $900,000 on reverse mortgages, senior citizens could not only do things for themselves, for their quality of life, for their standard of living, but there's enough money on the table with a reverse mortgage that requires no payment for them to help out their children and grandchildren. I'm not saying to go ahead and do this. I'm saying, but the opportunity would be there. That's how big of a difference this is when we're starting to look at reverse mortgages today. So check that out. And do me a favor. Like I said before, sharing is caring. Sharing is caring. So hit the share button if you thought the information was good today, and I'll bring more of it back to you tomorrow. I will get my editing a little bit more tight as we're going forward here. Again, this is just, it's a little wonky. It's a little wanky. I'm using a thing called Streamlabs right now, and it's something of a pain in the butt, but we're going to get this thing dialed in here again. Leave me any comments, any questions, any interviews, anything that you'd like me to cover. I would be more than happy to. And with that said, I hope everybody has a great Thursday, and I can't wait to see you until tomorrow. So tomorrow it is. And make sure you check me out at thenationalrealestatepost.com. Thenationalrealestatepost.com. It's free of charge. Video every day. All right, guys. Talk to you soon. Bye.